So I found this post on Reddit in the options subreddit that's geared towards new options traders, and looking through, it had a lot of really valuable information that I wish I knew when I first started out. So I thought I'd share it here on YouTube. Options aren't stock. They're adjacent to stock. Don't trade options like you trade stock. It will cost you money. New option traders treat options trading like stock trading. If they believe a stock will go up, then the new traders buy calls, usually out of the money or maybe at the money. If they believe the stock will go down, the new trader buys puts, usually out of the money or maybe at the money. It's not that this is inherently wrong, but it's trading options like you're trading stocks. They're apples and oranges. You wouldn't look for houses to develop and flip in the same way you would look for racehorses to develop and flip. Once again, those are apples and oranges. New option traders generally don't appreciate how much more correct they need to be when applying these strategies. If you buy stock, you only need to be right about the direction. Timing and magnitude only really matter for end of the year P&Ls. If you buy a call or a put, you need to be right about the direction, magnitude, and timing. Most people who simply go long calls or puts are losers in the long run, at least with their options trading. I used to be a trader 15 years ago. I understand the thought process, but in my honest opinion, it's incorrect. It's a losing setup. One caveat is you have insider information. It's illegal in the US to trade on insider information, but an overwhelming amount of evidence shows it happens frequently. I'm not going to comment on the merits or demerits of insider trading, but if you have insider info and you're willing to trade it, most of this post is null and void. Options trading isn't stock trading. It's adjacent to stock trading, but honestly, only barely adjacent. If you're long stock, increasing volatility doesn't change the fair price of the stock. If you're long a call or a put, increasing volatility dramatically changes the price of the option contract. More than anything else, most option traders are trading volatility changes. If you're right on the direction of the stock move, but wrong on the timing, you're not markedly affected by the incorrect timing in your simple long/short stock. If you bought a call or a put, being wrong on timing is devastating. In the most extreme situations, you can be wrong by one day, and it can be the difference between losing all the money you used to purchase the contracts and winning ridiculous sums of money. Second only to volatility, most option traders are trading time. Even still, you can be correct on direction, correct on timing, but incorrect on the magnitude of the move. When you own stock, that simply means you earn less than you expected. When you're long calls and puts, that can, and often does, mean you lost all of the money you put in. So option sellers trade two things more than anything else: volatility and time. Stock traders don't trade either of those two things. So don't treat options trading like stock trading. Strategies at the end about how to treat options trading like stock trading if you want to otherwise ignore this advice. Generally, the buyers of option contracts are net losers. That doesn't mean you can't be a buyer of contracts and be a winner. You can. I know a couple of folks who do that successfully and have for years, but it's a harder road than just being a good stock trader. You need to be great at picking stocks and good at trading options. Generally, the seller of option contracts are net winners. Similar to buying calls and puts, I know several exceptions to this rule of thumb. Losing option sellers do not do a few things correctly. First and foremost, they risk too much. Can be said for unsuccessful option buyers as well. They don't understand the Kelly criterion, or understand how much inaccurate assumptions can affect Kelly. Successful traders I know only use 1/2 Kelly or less due to the lack of firm percentages. People often also misunderstand what risk is in Kelly. Using stock as an example, if you buy XYZ at $100 a share for one share, you spend $100. But you haven't actually risked $100. The full amount of the $100 risk isn't at risk unless XYZ drops to zero overnight. If you place a stop at $90, you only have $10 at risk in most situations. So in a given trade, 1/2 Kelly's says you should risk 2%. You have one share at 100 with a stop at 90, and your trade account is worth 500, you're risking exactly the 2% that 1/2 Kelly says you should. However, if you only have $250 in your trading account, you're risking 4%. That's double what you should risk. You're going to blow up your account if you do that. If numbers like 4% seem low, you really need to read up on Kelly and the math behind it, or read The Market Wizards and New Market Wizards. It's been a couple of decades for me, but in both of them, I remember nearly all the traders talking about risking more than 2% trade is being a ridiculous pew-pew cowboy. These are all top traders of their era who would have likely been more comfortable with risk than their contemporaries. And yet, they almost unanimously agree on what feels like, to most, extremely small levels of risk. We know more based on Kelly, but also know that overestimating probabilities when calculating Kelly can quickly change good sizing into poor sizing, which is why 1/2 Kelly is usually the max for most successful traders. Second, losing sellers of option contracts misunderstand or underestimate how changes in volatility affect their position. In doing so, they often sell too many contracts during low volatility. The inevitable increase in volatility wipes them out. This ties into risking too much, specifically risking too much environments that aren't necessarily favorable to selling. Finally, whether long or short, winning option traders know how to manage their positions once the positions are put on. How do you know how to do this? Practice. But practice doesn't mean you need to trade and lose a bunch to figure it out, though that does tend to cement things into place rather quickly. Bring up Thinkorswim or whatever broker you use and put on a simulated trade. What happens if it moves against you? For you then back against you then back for you. What happens when IV goes up a little, goes up significantly, goes up against you? For every one of these situations, you should always go through all the options to change the trade. For every one of these positions, you should understand why. If I'm short an IC and the stock is testing one of my legs, should I roll up the untested leg? Why? What additional risk does that bring? What benefits? When should I get out of the trade? What should I do if my IC stock keeps running relentlessly? What about when it moves 10% then stays? Do that for every position you consider. Do it 100 times. Do it 1,000 times. If you don't know how to manage and defend a position, you probably shouldn't be trading that position yet. Maybe find a way to use positions you know how to manage, and then also increase your knowledge in how to defend your position you rather would have taken. Read traders' blogs. Watch Tasty Trade videos. Get any knowledge you can, then don't accept it at face value. You still need to work through all the examples. Why is this blog saying do X? Why does Tasty's Trade say do Y? What risk does this strategy mitigate? What risk does it reopen? You need to know these answers. You need to know how you can best react within your risk level to all these situations. Figuring it out on the fly doesn't work in the market. You will lose your money if that's your outlook. Now, if you're new, you aren't yet thinking like an options trader, and you want to trade options, there are a few good ways to do it. If you think a stock or an index is going to go up, buying deep in the money calls with a delta of at least 90 is a good start. You get to participate in nearly all the moves of the underlying, but get to do so at less capital expense. Deep in the money options have very little of their value in extrinsic value. If you don't know the difference between intrinsic value and extrinsic value, now is the perfect time to do your first Google search in your quest for more options knowledge. Do not control more underlying than you would if you were trading straight stock. If I'm not going to get any leverage advantage, why would I even pay the premium instead of just buying the underlying, you ask? Well, for very little premium and a far lower capital outlay, you get to control the same amount of underlying. You can take that extra capital you didn't put in and buy some low-risk, interest-bearing instruments. If you normally are simply long S&P 500 index funds, for example, now you can be long deep in the money calls on that same fund, but take the other 50% of your capital and gain another 2% interest on interest-bearing instruments. If the S&P gains 10% over the year, you're getting 11%, 10% plus half of the 2% interest rate, since only 50% of your money is in the bond. It's the simplest and easiest way to beat the market every single year. You just need to make sure you roll your calls forward before expiration. Or you can buy at-the-money calls and sell at-the-money puts to potentially even less capital outlay and invest even more money into interest-bearing instruments. Or you can buy deep in the money calls and sell near-term out of the money calls to make synthetic covered calls and collect on time decay. Doing so would free up a lot of capital to invest in low-risk, interest-bearing instruments or any other instrument of your choice. It would allow you to collect time premium every month, thus lowering your cost basis even further. You want to short a stock, but can't because it's in an IRA and the rules don't allow you to? Buy a deep in the money put. The point of this ridiculously long post is that you shouldn't jump headfirst into options trading. More sophisticated traders will eventually take all the money you allocated to options. Get a good understanding and start small. Do lots of research and lots of what-if exercises. Start with a few strategies and learn them inside and out. Only then, add your next strategy to your arsenal. Don't trade options like they're stocks. They aren't. They're a completely different animal. Respect that. Learn what's different, why, and how it affects your trades. Eventually, learn the Greeks way deeper than you think you need. After that, you'll be able to start coming up with actually good trading setups. But only after you understand the Greeks deeply and can simply know how changing any of them changes your position, strategy, what options you have to defend and adjust, etc. The path to being a good, successful options trader isn't sexy. It's boring, it's work, but it's doable, so do it or stick to stocks. If you ignore the last sentence, you will lose money in the long run. So if you made it this far, let's go ahead and sum up some of the key points. So first, learn first what you need to do. Don't just try to learn on the fly. You should know how to fix a trade before you need to fix it. Trying to research how to do that or ask someone else for help when you need to manage it now is pretty hard to do. Learn how to manage risk. Think about your position sizing, how much to bet on a particular play, how much you put at risk on that play. You've seen from my videos, I've paid a lot to learn that lesson myself, so you don't have to pay that same price because you can learn from here. Stick to a trading plan and control your emotions. You've seen me size up too quickly before and take losses from that. And if I stuck with my original trade plan, it would have came out with a profit. Think about how to manage a trade before you need to. And then options are not stock. Like there is a different style of trading with them. So if you're used to trading stocks and you're switching to options, take it slow. Learn the rules of the game first before you start going to the pros. And then finally, find good resources to learn from, such as this channel. Hit that subscribe button.